Hello, I'm Casey, and this is Taylor, and welcome to this video edition of the Cadence Capital newsletter.
What are we talking about today, Casey?
Well, we always like to talk about the topic du jour, and I think we have a doozy today, and it's really not even the topic du jour. It's been the topic the last few weeks.
So that would be Silicon Valley Bank and the possible banking crisis that was looming as that started.
Right, and back when that started, that was March 9th and into March 10th, a Friday, where it hit the mainstream. Certainly there were rumors and murmurs before that there were problems looming, but ultimately, just to reset for everyone, the bank had a classic run. And while that's self-evident, we want to take a quick moment to understand what happened. And there's some accounting nuances that we won't get into the weeds of today, but we're happy to visit about. We certainly have with a number of you over the past few weeks already. But essentially, they held some bonds on their books that they were intending to hold all the way until maturity.
When they'd get their money back.
When they would get their money back. And they were extraordinarily low interest rate. Their expected yield was below 2%. And there's really no problem with this. However, at one point, they need to raise capital. They want to redeploy elsewhere. The motivation really doesn't matter. But because they were going to sell these positions that had a special accounting treatment, when they made them available for sale, which again is the accounting treatment name, available for sale versus hold to maturity, that caused a recognition of some downward movement in the price and negatively affected their financials.
And that's where
the
general population got worried about the bank and asked to start pulling their money out.
Yes, and it's a little bit understandable too why the concern was raised by their depositors, as their depositors were extraordinarily exposed to FDIC coverage gaps.
And that's where the questions came into us, and that we were fielding Friday over the weekend on Monday. What is FDIC insurance? What is Raymond James's protection from something similar to this? And those questions were very valid and relevant. And we reminded everybody FDIC insurance is for banks. And I think everybody has learned what that coverage is now, the $250 per person. But what does Raymond James have? Raymond James has what's called SIPC or SIPC coverage in place that's above and beyond what FDIC insurance is.
Right, and I think it's important to note that those partner banks and collecting additional units of $250,000 coverage, it all occurs within the Raymond James account.
Right, inside the accounts at Raymond James. So you're not having to have multiple accounts across many banks. It's done inside the Raymond James biosphere for you. So there's just one relationship you're having to worry about and not multiple account titlings and things like that at different banks.
Yeah. And worry may be the wrong word or imprecise word to use there, because really the worry of contagion with Silicon Valley Bank was largely overblown, in our opinion, in the moment, but certainly seems to have been proven out. The unique risk that they had, the managerial decisions that they made, certainly there were a few peers of theirs that were similar, but this is not likely to spill over into the broad populace of banks, and certainly not the large brokerage firms like Raymond James or peers.
So in addition to the cash side of things for liquidity purposes, what other options do we have available for our clients?
Well, it's nice in that we have more options now than we've had for most of the last decade. And that's simply because interest rates have been rising, which was a large part of the problem that Silicon Valley Bank experienced, a negative reaction to that. But as yields have risen, we now have CDs being more attractive than they've been for the past decade.
Less than 25 basis points or 0.25% is...
Oh, those were the days. But today they are attractive. Many are paying well above 4%. We don't know if they'll stay that way for long. But for those that are trying to lock up some money into attractive interest earning accounts, CDs are available, and those actually can be done within the Raymond James account as opposed to going to XYZ, any number of banks and trying to manage it yourselves. Like the Raymond James Waterfall program on cash, they can be bought within a Raymond James account for ease of convenience, 1099, consolidating all the tax reporting. And then later, as those mature, or if you trade out of them, it can be redeployed into whatever is most appropriate at the moment. And right now, at the moment, what we're finding extraordinarily attractive is money markets.
Yes.
Over the last few months, yields have increased dramatically, and they really are a welcome relief for cash reserves, especially as inflation pressures have started to wane. We're no longer giving up a lot of yield relative to inflation or giving up purchasing power. And it's really a welcome relief for those that want to get a bit defensive, or like us, we just want to tilt back to more of a neutral position from a years-long overweight to equities while there weren't good, attractive, safe options. But one final idea that we are exploring, and we've been talking about this for a year now, is we are starting to march out on the maturity curve for bonds.
What bonds? Didn't you say that's what got the bank in trouble?
It was, but you could say that the bank was early in their decision to unhedge, but I think that would be a gross understatement of their decision making. We like to align ourselves where math favors us. And it was literally a year ago in our first video newsletter, we talked specifically about the pain that we were expecting in the bond markets. That's the same time that Silicon Valley Bank was deciding not to hedge any longer. They were willing to accept that. And I am not suggesting that it was us versus them in a viewpoint. We certainly were in the masses in that we expected there to be a lot of pain meaning negative price pressure on bonds due to a rising rate environment. But they were definitely on the wrong side of that call for whatever reason. But that doesn't mean that will continue forever. We're not going to continue to experience, in our view, the same kind of lift in interest rates that we have over the past year, which is what causes negative price pressure on bonds and the concerns that fell out of that.
Right. And as we always talk about with each of you, liquidity is paramount. And that was part of what the depositors were making a run on the bank for, is they were worried about their own liquidity and troubles at the bank. And so they were rushing to take money out to give themselves liquidity somewhere else in case the bank failed. Fortunately, too many of them did it, and the bank didn't have liquidity anymore.
Yeah, and there were a lot of factors that led to that, not just the fear that those depositors had with the bank, but roughly half of the deposits as of December 31st, 2022 at Silicon Valley Bank were non-interest bearing. So as money markets and CDs and traditional bonds and many other things are becoming more attractive, their very large corporate sophisticated investors are earning nothing. And this may have just been a catalyst point where, okay, now there's a reason to go and repurpose those dollars, and again, led to that run.
And that's conversations with each of you, is if you have that low yielding cash sitting somewhere, there are ways to be more productive with that. Just to have a conversation with us, and we can look at your specific situation and see if there's a way to tune that cash up and still have the liquidity that's so paramount.
One other topic this time frame has afforded us the opportunity to reconsider is plans for debt.
Yes, so many of you have variable rate loans out there, and given the rate environment, those loans are a whole lot higher than they used to be. And so we're taking action with clients that have high rate variable loans to pay them off. As we've seen in the last 12 months in the portfolio, there are things that are up for many people, and taking the opportunity to trim gains and pay down those loans is important to us.
Yeah, but I would add, we don't necessarily want to close a line of credit or debt facility. We expect there'll be a time where rates come back down, and the rate on these lines of credit will come down as well, and we may want to access them again in the future. But
for liquidity planning.
Yeah, for liquidity planning, or even tax planning from one year to the next. But have that conversation with us, please, if we've not already, and we can help make prudent decisions for you. But there is one last topic I would be remiss if I didn't use this as an opportunity to bring up. We speak of it often, but the economy and the stock market are not the same thing. And I know that everybody that we spoke with in the week after Silicon Valley Bank's debacle, let's just call it, there was a linear connection being made and natural concern that the stock market is going down. That here we go, this is what we've been waiting for.
Chicken Little, you might say.
Chicken Little, you might say. Not the person, but just the general viewpoint. And it was rational. It makes all the sense in the world. Yet here we sit as we're filming this today, a little over 2 weeks later, and the U.S. stock market is up, international stock market is up, and broad bonds are up as well. All the major indices are up. And it defies logic. We understand that, but there is simply not a linear connection between those big topics of the day that are dominating headlines and what will happen in the market. That just doesn't, the world doesn't work that way.
So takeaway from that is make sure we stay diversified. We'll always have options. Even if it looks like things are going wrong, in the portfolio. Liquidity is most important, and we want to make sure that cash is available when people need it. That gives us opportunities to plan around those needs.
And stay diversified. That sounds like a lesson that Silicon Valley Bank and their depositors would have benefited from hearing sometime in the past.
Absolutely.
Yeah.
Well, thank you for watching today. We look forward to conversations with each of you coming up soon.
Bye.